So chapter 18, we're going to do some financial analysis talking in terms of to find out what is financial statement analysis, why do we need it, why it's so important, who's using it, for what purpose using it, and what's in this analysis. So let's start with purpose and from where we're getting the information from the financial statement analysis. Obviously, financial statement analysis, it comes from the based on the financial statements. As you already know, we have five financial statements. The financial statement, when somebody says financial statement, they have five elements inside. Always start with the income statement, then we go to statement of owner's equity, then we go to the balance sheet, then comes to the statement of the cash flows. Cash flow is plural, and we finish with the notes to financial statements. So the annual reports, that's the major source for the internal managers and external analysis. Why the people need financial reports? Because people have money. And person who has money, he wants more money. The question is from where he can get more money. Now, based on the basic accounting equation, which as you remember, the basic accounting equation, I'm going to use here the slides, was that, let's make it generously bigger here. As you remember, the basic accounting equation in asset is equal to liability plus equity. So the way I see it, the assets are the ones that are controlled by the company and used from the company to generate operating income. Then what's the liability? And equity, those are the two instruments that somebody or the investor who has money can invest in the company. That's what we saw in chapter 16 about the investments when we're talking about investing in equity and investing on the liability. Those are the two options that we have. There's nothing else. So the question is, what do we expect? What the person who has money, okay, he decides, okay, I'm going to invest in the equity of a company. What do I expect? I expect a dividend. What else I expect? I expect that company to start generating income, which is going to increase my dividend. What else I expect? Once the profitability of this company increase, I expect the market value of the shares to go up as well. So you have the direct return in terms of dividend, and you have indirect return in terms of increase the market value of the shares that you bought. That's for the investors. Now that's for the equity, the one who's going to invest in equity. Now we bring us to the other party, which are creditors. What the creditors focus, what they want interest plus repayment of debt. So what they're going to look for? They're going to look for, is this company has ability to generate cash? Is there any threat for long-term solvency with this company? Means that the company is going to come to the stage that won't be able to generate cash. Because the way I see it, the only thing the bank cares about, if you go to the bank and you ask for the loan and the mortgages first, is this person has ability to generate cash? Why? Because I want my money back, plus I want this person to pay me interest, to pay me the interest when I want to pay me interest, and to pay me the interest how much I tell him to pay me. That's why you have on the mortgages. So we already saw that the scale, you have a fixed percentage, we have the variable percentage. They can smile at you and they can give you as many candies as you want, but at the end of the day, you are not there for the candies, and they're not give you the money for the candies. They give you the money because you have ability to pay them their debt back, plus the interest from that. So which is the method of analysis? We have three, so those people have to make a decision. Which company should they invest? Which should they buy share, or should they become a creditor for the company? And then you're going to use the financial statements to evaluate the company performance. Now, the three main financial uh, three way to analyze the financial statements. One is to comparison year to year. That's called horizontal comparison. Then you're going to have another one, which is compare the company with a different company. That's called vertical analysis. And then we're going to have specific financial ratios based on different criteria, which are related to the three components of the accounting equation: asset, liability, equity. And we're going to start interpreting those financial ratios. So, analysis obviously will include to compete with the company to find, is the company competitive, is it not competitive, can we compare it with another company, can we compare it with the other company, which company we can compare it. Also we're going to have standards about the industry. So company within the industry doesn't meet the standards for that particular industry, which company is. So let's start with the horizontal analysis. Horizontal analysis, obviously, the name tells you that we comparing number over the years. We have number, when you have, let's make it as simple from the statistical point of view. If you have 2 years, we can talk about differences. If you have more than 3 years, 3 or more years, at least 3 years, and if you have more, that's even better. We can talk about trend. In the 3-year trend, that's a very big stretch, but we still can talk about it. Now, what we're going to do, we're going to put the information presented in the same way, in the same categories on the income statement, the balance sheet, and we start comparing year to year. We're going to choose 1 to year to be our base year, and then we're going to start comparing every other year to that base year. Again, we're going to start doing percentage changes. We can do the differences between 1 year to another year, but we're always going to try to express it as a percentage. Computation, the percentages, again, compute the dollar changes from the earlier period to the later period. We're going to choose 1 year as a base year, then we start doing the comparison. For example, this will be this company. We have 2 years, 2024 and 2025. Now, once we go with 2024, 2025, obviously the earliest year is our benchmark or our base year. And then we start seeing what's the difference between that year and the current year. Current year minus the base year, which is 2024, is $275,000. Or this case is million. Now this 275 million, what's that change in the, as you can see, sales going up with the 275 in terms of the percentage where we are. So that increase to 75 divided by the sales in the base year is going to give you increase as a percentage. And then we can simply do the comparison line by line on the financial statements, starting again with the statement of income. And we can see here the sales. Now the sales going up with 31%. Cost of sales going up with 32%. So in overall, we're going down to 30%. And then start expressing 1% versus 1 year versus another year in terms of the percentage. We can express this as a dollar amount as well. Then we can move to that was for the income statement. We can move next to the next financial statement, which is the balance sheet. And in the balance sheet, we can see the changes 2025 compared to the base year. Is the change favorable? Is it not favorable? Is it in the now, if we have information about the industry, we can compare these changes with the industry and see how the industry performs. And the same thing once we do finish with the assets and do the comparison between the total assets of the current year and the past year, and we find that our total assets increase with 94%, then we can see the same increase on the total liability and shareholders' equity. Now, the thing is, from where that increase mostly came? Is it come from the equity or did it come from the liability? As we can see, it comes from the liability, not from the non-current liability. It actually came from the current liability. We have enormous increase in the loans and provisions, and the huge increase with 52% increase in accounts payable and current liabilities. But again, the main increase comes from the loans and provision. We have 836% increase, which is generous. Now, the trend analysis, again, is the form of horizontal analysis, indicate the direction of the business. In order to have the trend analysis, remember, you have to have at least 3 years. We're going to choose 1 year as a base year and start expressing every other year based on the base year. This company now has 1, 2, 3, 4 years. We stuck in with 1 year, the 2022, it became our base year. And then we start comparing 2023 to 2022, 2024 to 2022, 2025 to 2022. And we start with first one. Since the 2022 is our base year, everything will be pros on the 100%. And then we're going to see compared to the 2022, 2023 has 140% increase in sales, our gross product sales. Compared to 2022, in 2024, we have increased in 170%. In 2025, compared to 2022, we have 270% increase, which gives us, now we can start talking about the trend. Now, at this point, if somebody asks you, what do you expect to happen to 2026? Most likely, we're going to see an increase in our gross product sales. And that's with horizontal analysis. And nothing scary, it's just a comparison 1 year to another year on the horizontal level. Let's move to the vertical analysis. Vertical analysis, now we start comparing company with the other companies. Before I do that, we have to understand why we're doing this and how possibly we can do it. I'm gonna quickly go to Excel spreadsheet. I'm gonna share my screen with the Excel spreadsheet table. I wanted to fill it first and then explain it to you. I'm gonna stop sharing these slides and let's go and share you the Excel spreadsheet that I just opened. That's the Excel spreadsheet. So question, let's make it bigger, generously bigger, say 26. You have two companies to compare. Both companies have sales. Both company has cost of goods sold. Both company has a gross margin. And both company has operating expenses and both company have operating. That's very simple. We're going to keep it very, very super simple. Now, in one company, the sales are 20,000. No, sorry, 100,000. $100,000 sales. That's how much they generate. It's a local grocery store that's generating $100,000 sales per year. Cost of goods sold for those companies are 20,000. So that gives them gross margin of 80,000. Operating expense another, let's say 15,000. And this company end up with operating income of $65,000. Well, that's one company. Let's label it company number one. Now we have another company. But the interesting thing with that company number two, the sales are 10 million. Then cost of goods sold are in this company are 8 million. Obviously, gross margin will be 2 million. Operating expenses 1 million. And operating income 1 million. If you have to invest your money, in which company you're going to invest? Company number one or company number two? First question that we should ask ourselves: can I compare company one to company two based on the sales, based on the gross margin, based on operating income? Can I compare those two companies? Is there anything common between those companies so I can compare them? So somebody says, let's invest in company number one. If you say number one, why? If you say number two, why? It looks like the company two will be a way better because they generating operating income $1 million. The other company generate 65,000. Why would you waste your money on a company that generates only operating income of $65,000 rather than going with the company that generates operating income $1 million? Yeah, go for it.
I would invest in the first company because it's the operating income is 65% of the sales,
How did
while
you
the
calculate it?
second,
How did
yeah,
you how did you calculate it?
65,000 over 100,000.
65 divided by 100,000. How about the
Yes.
gross margin?
The gross margin is 80%. Yeah, 80
80%.
divided by 100.
How about the other company? Let's
The
compare it
other
with the other
company
company.
is only 10%.
So how are we doing then vertical analysis?
I don't know, maybe the ratios?
Ratios, but how do we get the ratios? Which one is the base for us? Sales.
Yes.
So if the sales are our base, as a percentage, how much are the sales?
100?
How did you get the 100?
100,000 divided by 100,000?
It's gonna give you?
100.
No, it's gonna give, let's do it. Watch this. 100,000 divided by 100,000, or let's do it this way. Now, this one divided by this one, it's gonna give you 1, which one represents 100%, correct?
Yes.
That's how we get there. That's exactly my point. Okay, excellent. So, if we have to do analysis, vertical analysis, we're gonna choose one of the numbers on the statement to be 100%. And we're gonna start expressing the other numbers as a percentage of that number. Now, on the income statement is very fair, straightforward. You always and always every statement start with sales. And now the question is, this is the money that's coming in the company. Now, what we have to do is for what we're using those money and how much left. So in this case, you're correct. We should invest in company one because they generating for now. Can you please, before I continue further, can you please explain to me, let's say the company, I'm gonna make it a little bit simpler. I'm gonna put here 100, 10,000. 1, 2, 3. Let's leave it 70%. Pretend that I'm 3 years old kid and explain to me. You can use any examples that you can find in the real life. Explain to me what the 70% means to me. Pretend again, I don't have education. I'm a 3 years old kid. Come on, people, we have to convince. We have to explain to this 3 years old kid what the 70% means. Because one day you have to explain to the owner of the company what the 70% means to him, what the 80% means to him. How can we explain this? If the 3 years old kids can understand you, then you can explain this concept to everybody.
Yeah, providing that the old kid knows like, basic elementary school mathematics, like 1 + 1 = 2.
No, 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 no,
You
no.
know.
The kid is 3 years old. He doesn't know anything about math, nothing.
Oh, yeah, I can see why that's hard in a sense because like that's like you with your knowledge trying to explain to us who have little knowledge of the subject. And you must define the terms. Like that's how I learned it in English 1130. Like you can't say this article has accumulated numbers of genetic mutations. You have to define what you mean by genetic mutations and so on. It's
Correct.
like, yeah, in order to attempt to do that, it's just that I don't actually know too much about. I mean,
So
no,
let's go. Let's see what Shimon. Go for it. Explain to us, like, pretend that I'm 3 years old kid. Explain to me 70%, what that means to me. You have all the examples in the entire universe available for you. Go for it.
so was that for me or was that for
No,
someone else?
that Shema?
My name is Yamal.
No,
Okay.
but there's a raising hand. Okay, go for it.
For every $30 that you spend or that you invest, you generate $100.
I'm 3 years old kid.
Okay. So if you have $30 and you
Again,
buy
I'm 3 years old kid. I don't understand the words.
um
Keep going. Don't give up.
I don't really see how.
Think about it. What the 3 years old kid likes.
Toys, like
That's one thing.
baby toys,
What else he likes?
cards, maybe.
Also what he likes. Keep going.
He likes toys,
Watch
cards,
this.
TV.
Xiaolin, go for it. Go for this. Explain, please. That's a very good example. Oh, okay. My mic does okay, good. So watch this. What she's saying is you're giving the kid 10 candies. But where's the catch? Only 7 of those candies you can eat. The other 3 are mine. That's
Yeah.
70%. Make sense? The other thing is what the way that I was expecting you to come up with, uh give the kids give the kid cake. Do you see this is your birthday? This cake is yours. However, you can eat only 7 pieces. 3 pieces are mine. In the other company, oh, you got okay, good. That's good. Your brother get three pieces. I like this. I love it. Okay, how about the other company? Explain to me 10%.
That's easy. Can I do it?
Yes, please. Go for it.
Okay. So you have a full cake, and the cake is comprised of only 10 pieces. I get 9 pieces, you only get one piece.
And what's the next the comment from the kid? How this is fair,
How is this fair?
right?
Yeah, how is this fair? It's kind of
Uh,
like creative writing, where like introduction to children's literature,
uh,
where you have to simplify complex ideas into like baby language.
So, do you understand what you have to do as an accountant? Explain to people complex idea in the way that they can understand you, having in mind that they don't have accounting background and they don't know anything about the finances. So you have to
Yeah.
explain the owner of the company what the 10% operating income means. Simply means on every dollar of sales that you're getting, you can keep only $1. The other one, $9 going for your expenses. Or sorry, from every dollar that you're generating sales, 90 cents going for your expenses. You can keep only 10 cents. What will be his reaction? What? Only 10 cents for every dollar sales? And this company? What's going to happen? For every dollar that you invest in this company, you're going to get 70 cents. Now that brings us to the question, then another question, which you can personally feel it. How many of you working? Is there any one of you who's actually works? Okay, at least one person work. So, have you received paycheck? Okay. So, what's the first line on the paycheck? When you open your paycheck, what's the first line? Usually, those are the money that you want, the money that you like, but the money that you're never gonna get. That's we call gross income. And then we're going what? After that, we're going deductions, 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 and then you're gonna get net income or money deposit to your bank account. What's the money deposit in the bank account? Usually the amount that you don't like, the amount that you don't want, but the only one that you're gonna get. So the question is, for the every dollar that you're earning, yes, that's what he's meant. For every dollar that you're earning, actually earn, how many cents you getting? Did you ever done this calculation? If you earn $1, correct? Today you work, let's say the employer pays you $20 per hour. You're working, let's say you're international student, you're working 5 days, five hours. So today you're generating $100. Are you gonna get $100 or not? No. Now the question is, because the $100 is your cake. Now the question is, how many pieces going to your brother and how many pieces going to you? That's how you interpreting the percentages, and that's how you see the meaning of the percentage. Now, when you on the vertical analysis, when you go with the percentage, again, if I stay only with the numbers, I cannot compare two companies from different industries. That's impossible. But if I go to something common between the both companies, which is the percentage, Now I can start comparing those companies. If I only stay with the dollar amount, I cannot compare them. They're different reality. But if I convert everything, these numbers in the percentage, now I can compare those two companies. Now I can decide in which company to invest, which company not to invest. This conversion from the numbers to the percentage is called common financial statement analysis. Let's go back to slides and let's continue with the slides. And to see what the slides tells us about. So again, vertical analysis is going to review relationship of each statement item based on the something that is 100%. For the income statement, 100 is always and always sales. For the balance sheet, well, on the balance sheet, let's go to the accounting equation. Just a second, let me share my, let's stop sharing this and go back to the Excel spreadsheet. From the balance sheet, we have to remember what is the basic accounting equation, which basic accounting equation is represented on the balance sheet. And that was asset is equal to liability plus equity. Correct? So now the question is, which one is 100%? Asset is 100%. If the asset are 100%, and what do we have on the other side? Can I have something else on the other side? Is it possible if on one side of the equation I have 100%, is it possible on the other side of the equation to have 120%? Is that possible?
I say no as well.
No. So how much will be the liability plus equity? It has to be equal to the asset. As a percentage, has to be equal to 100%. Make sense? So when somebody asks you, what's the capital proportion of your company? Well, which one is the capital? Capital is your asset. How much is your capital? 100%. So what kind of options I have on the other side of the equation? I have 50-50. Or I may have, because those 50 plus 50 have to give me 100. Or I may have here 0-100. Why? Because I know my assets are 100%. I can have 20-30. So what's your capital structure? Sorry, 20-80 to give me 100. My capital structure is I rely 80% on the equity and 20% on the liability. Why? Because my total assets 100%, total liability and equity are also 100%. So now, knowing that, let's go to the slides. I'm still working with the slides now. Is this make sense? The capital is the entire assets that you have the company. Assets are your capital. Through that assets, you have to generate income. The question is, from where did you get those assets? Then you have only two options. Either you have to borrow money, either you have to get somebody to invest in the company. That's why your total assets are presenting 100%, and total sales, the money that you're getting from the clients, is 100%. And then you start expressing every each of the item based on those items. On the income statement, again, sales are 100%, and then you start expressing every each number of the income statement based on sales. And as you can see, the percentage start getting lower and lower and lower and lower and lower. Why? Because everything after sales is deduction, 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 deduction. On the balance sheet, my total is the total assets. That's my 100%. And then I start expressing how much is the portion of the non-current assets compared to the current assets. And as you can see, 63% of assets are uh, current assets, the other 27%, sorry, 37% is non-current assets to give you 100. And start expressing every each item based on the total. On the liability and equity section, you're gonna have 100% for the total liability and equity. And then you start trying to find out how much is the total liability as a percentage compared to the total equity. In this case, our capital structure is 57% relying on the debt, and the remaining 43% is on the equity. And that's the only thing that we can get from this analysis. Now we're coming to the common size financial statements. Again, common size financial statements is used to compare one company with another company. In here, we comparing one element of our financial statements with another financial. How much is the cash out of the total assets? Cash is 30%. How much is the liability out of the total assets? The liability, current liability accounts payable is 27%. And then we can play different games. We're gonna see with a little bit later what kind of information we can extract more. Now let's go with the common size. With the common size, now we're gonna give us ability to compare different companies from different industries, or maybe the same industry. So what we're gonna do? We're gonna report only the percentages from the vertical analysis. And then we're gonna start analyzing those changes. Again, numbers, those are irrelevant. Percentage, it's irrelevant. Income statement. Each item is going to be expressed as a percentage of the net sales on the balance sheet. Each item is expressed as percentage of the total assets, or as we know, the total assets are equal to total liability plus equity, total liability and equity on the common size. So once we run this, we can start comparing one company with another company, how much cash they have. Are they one have more cash or less cash? How much accounts receivable they have? What's the total current assets? And that brings us to the benchmarking, which benchmarking is comparing us with the industry or within another company within the same industry, which is the leader for that industry. There are two main types against another company and against the industry average. Don't compare your company too much and don't compare yourself too much, because the only thing that you're going to achieve is you might be happy, but later you might not be happy. For that reason, use the comparison, but only to draw the conclusions and to prepare for the next period and to see what kind of changes you have to implement in your company. From where we're going to get this information in order to prepare the benchmarking, to prepare the vertical analysis so we can compare each other with the other industry, that will be reports, any reports from the financial statements from the company. I told you in the CEDAR, you can find information about the financial statement of our company, newspapers, business publications, credit agency, financial data, Statistic Canada, all this you can find. Now the benchmarking example here is you having those two companies and you can put it in the pie chart. Again, uh, remember when you see pie chart, think about 3 years old kid. And first you can know the pie chart. Why is the pie chart? Well, obviously it's a pie. but in this case, we don't use, it can be cake chart. It can be pizza chart. Because all of them have a round shape. And all of them with the pizza is very easy to explain with the kid. You see, the pizza has 10 pieces. You can eat only 3 though. The other 7 are mine. Sorry. Or in the cake. This is your birthday cake, but there's a catch. Only one piece of this birthday cake is yours. The rest is not. You're not touching it. And here in the pie chart, again, you're going with explanation of how this works. And that brings us to the standard financial ratios, the last element for comparison. Now we're going to break the financial ratios in different categories. Before we do the ratios, we have to know how to calculate the ratios, which I'm going to show you today. You don't have to remember those calculations because for the ratios, you always have a formula. The most important thing for me is you to interpret the ratios. Is this good for the company? Is it bad for the company? Is it good for the business? Is it bad for the business? Is the business comparable for the other business? Is it profitable? Is it not profitable? Where is it? Many companies going to include those ratio analysis in the special section of the financial report. So we can measure the ability for the company to pay the current liability, sales inventory, collect the cash, pay long-term debt, profitability, share in the investment. So that those ratios are in different categories. First category is measure the liquidity of the company. Liquidity of the company comes from the working capital. Again, working capital comes from the accounting equation. From the accounting equation, we're going to get the portion of the current and current assets only on the asset side. And from the other side of the equation, we're going to get the current liability and current liability only. And then we're going to compare how much is the current asset versus the current liability. In other terms, how many times I can pay my current liability with the current assets that I have. And that's another thing you to look at that. So in this company, as you can see, one company has a current ratio, 79%, current assets minus current liability, 120 or some percent, 79. The other one has 27. We can express this calculation as a number or as a percentage. Percentage is more accurate and always works. So obviously, the first company is stronger than the second company because it has more assets, even though, actually, no, the second company has more liabilities. So the first company definitely in the better stage. Now for the decision making, we're gonna break this ratio, working capital ratio, into two ratios, which are important. Current ratio is the first one, and the asset test ratio. Now watch this. These are the financial statements, which they're gonna work with the financial statements all the way to the end of the examples. Now we have the income statement, then we have the balance sheet, broken by the categories and assets, liability, and equity. So what we're gonna do, we're gonna simply compare the current ratio with the current year and the previous year. Now, current ratio is measured current assets divided by current liability. Now, let's do some thinking before we continue. I want you to feel the ratio first, and then we can move on. Again, from the asset side, we're going to get the current asset. Long-term assets is not part of our discussion right now. I don't care. So, well, we don't care about this. I do care, but with this case, we don't care about the current long-term assets. On the liability side, we have current liability. And here I'm gonna put long-term liability. And the equity section, we know we have contributed capital, we have retained earnings. So from our working capital, we're gonna chase only and only those two items. Let's clear here with green. So our current ratio, it's always and always gonna be equal to the current assets divided by current liability. And that's gonna give you a number as a percentage. Now the question is, what means if the current ratio is equal to 1? What that means to you?
It means that the current assets are equal to the current liabilities.
Yes, that's exactly what it means. That means the current assets are equal to the current liability. Now, is it possible this ratio to fall below 0?
Yes, it is.
How?
If the current assets are less than the current liabilities.
Okay, let's check this one. Before 0, below 0. Is it possible this ratio to fall below 0?
I don't think
Mm,
so.
So
No.
no.
let's check current assets, current liability. And we have here current ratio. Let's play with numbers. Current assets, let's say $100. And let's move it to dollar amount only. Actually, the current ratio is not a percentage, people, just a number. That's not a percentage, that's just a number. Current liability are $100. So our current ratio is equal to current assets divided by current liability, correct? And that's a number. We said that's simple number 1. Is it possible that number to go below 0? Let's play with the numbers and see, is it possible? If the current liability are 0, then this number will be, what will be that? It's not going to be 1. It's going to be 100? No, it's not going to be 100. That will be hard to imagine it, but basically you don't have liabilities. So current ratio is just, in that case, what will be the current ratio in that one? 100%? No. 800 as a number? No. It doesn't make sense. Nothing. But if you have $1 current liability, my current ratio is 100. In this case, will be if it's 0, should be 100. Now, what's going to happen if the current liability climb above the current assets? If you go 150, my current ratio start going down. So what's the optimal and good current ratio? That's what the question. Definitely 1 is the good number because it shows me that I can cover my current liabilities. Above 1, what do you think? Is this good for our scenario current ratio to be above 1?
That's a very good thing because it means that the company, in case an emergency like COVID-19 or another emergency happened, the company has enough assets to cover its liabilities.
That is correct, but not only even if the normal course of business, keeping the current ratio above 1, that's a good thing. Now, is it make sense you to keep the current ratio, let's say, 10? What do you think?
Yeah, it
Is it
is possible, depending
it
on
is
the industry.
but is it good for the company to keep it 10? Yeah,
And
it is good. But so now in the current assets, you have to understand in the current assets, we're also including the short-term investment. The short-term investment is easily convertible into cash. Okay, so that's good. Okay, current current ratio. You understand what the current ratio. You understand the objective with the current ratio to keep it above 1. That means we have more assets than the liability, which is give us buffer against if the clients come and start pay me. This company keep the current ratio above 1, which is good. In the compared to the company, is this ratio going in the right direction? What do you think? That's a comment in the chat room. No. Why? Because the current ratio goes down. From 2022 to 2023, we have a reduction. So from higher than 1, getting closer to 1. Compared to the industry, definitely both years are good. But the 2023, the ratio going down. Now we're going to the next ratio, which measure the ability of the company to pay the current liability, which is called asset test ratio or quick ratio. Now, quick ratio is very close to the common ratio. However, in the quick ratio, you're going to show and including only assets which are easily convertible into cash. Means we're going to put the cash, we're going to put the short-term investment, and we're going to put the current accounts receivables. And that's all. Inventory, not part of this ratio. Prepaid expenses, not part of this ratio. Why inventory is not part of this ratio? Because uh, how do you know which assets are easily convertible to cash? Once you see the nature of the assets, you're going to see it. It has to be short-term investment. If I have, uh, can you think about it for a second? If you see the company have a GAC, guarantee investment, invested their money in GAC, which have a fixed interest and which is locked for 2 years. Is this easily convertible to cash?
no.
No. But if you see the same thing investment, which is easily convertible into cash, which is cashable at any time, is that easily convertible to cash?
Yes.
Yes. Now, the other question is why the inventory is not part of this equation? Because first, it's very common once you sell the inventory, you too have the accounts receivables. So in order to inventory to become a cash, we have one extra step, which is accounts receivables, which accounts receivables is included in the quick ratio. Prepaid expenses, the chances you to ask for your money back on the prepaid expenses are very slim, most likely zero. That's why it's not part of the equation. Now, that's the other thing that we can measure with those ratios, liquidity ratio, is our sales inventory and collection of the receivables. Here we have 4 important ratios. Inventory turnover, accounts receivables turnover, days in sales in inventory, and days sales in receivables. Now let's go first ratio, inventory turnover. Inventory turnover, we can gonna get it as a calculation between the cost of goods sold divided by average inventory during the year. How are we going to get the average? Inventory at the beginning plus the inventory at the end of the year divided by 2. Simple average, nothing more, nothing less. So now, Let's think about this number. Again, cost of goods sold divided by the inventory is going to give you the number. If I have here my so that's going to give you how many times you actually convert your inventory. If the number is 1, is that good for me or not? Again, if I get the inventory turnover number 1, what that means? That means I'm holding a lot of inventory, which is equal to the cost of goods sold. Those two numbers are the same. So is that good for me or not? Let's see what you're saying here on the. There's nothing in the chat room.
Someone said no.
No, yeah, and that would be the right question. But at the same time, we have to ask ourselves which industry we are.
Whether it be engineering, medicine, or another industry.
That would be one thing. So if I'm in the industry which I built, uh, military submarine, and my inventory is 1, and what that means to me?
It means for every inventory you have, you sell it immediately.
Correct. How many submarines I can produce per year? I would say probably 0. You probably need at least 2-3 years to produce the submarine. But let's switch the industry now. If I'm in the bakery business and I'm selling bread, and if my inventory turnover is 1, is that good for me now?
Yes, it is. Because
Is
it
it?
means you,
Is it?
wait, hold on. Actually, no, it's not because like there are, you need to have a bit more bread prepared just to be on the safe side in
No,
case
no,
you
no,
get
no, no,
more
no, no. You're missing the point now.
Okay.
Inventory turnover simply measures how many times you sold your inventory.
I'm gonna say yes. And the reason why I
Again,
think
so
it's
think
yes.
about it. Think about it. I'm
Okay.
in the bread business. I'm baking bread. Bread. Is it good for me that I'm selling my bread only once a year?
No, that's not good.
So, what will be a good number here?
Try 3/1, like 3.
Let's try 365.
Okay.
What that means to us? If our
Yeah, I see what you mean.
every day I'm selling bread. Does that make sense? Which brings us to the next ratio, which simply measures how many days you it takes you to sell the inventory. So if I'm in the bread business and my inventory turnover is 365 here, that means then I'm going to have the days in sales in inventory. I'm going to have 365 divided by 365, and I'm going to have 1 day. Is this the right ratio for me? If I'm selling business, what will be the ratio here, which is not going to be good for my business? 1, definitely. How about 10? Is it good number here? If my turnover is 10, no. If my turnover is 10, what that means to my business model? How many days I'm keeping the bread? So 36 and a half days. Would you buy my bread?
No, because bread expires very quickly.
Correct. So, what will be the right number here? That under which number you don't want to fall down? If you have to open your own bakery, 365 one day. If you go to what will be that? 283? No, 183. Is that good for you? 183. Think about it. Check 365 divided by 183. How much is it? So 199. What that means to me? How many days I'm keeping the bread? 2 days. Is that good for me for my business?
Depends where on the world you're selling bread. In Europe, I know
Yeah,
that's like,
yeah. You still on the 2 days, you're okay. I mean, yes, you can still sell it on the second day. Is it old? It's not that old. I mean, when you go to the superstore and you see the bread, that bread still easily 3 to 4 days, maybe,
I'm guessing also that applies to Subway as well. They sell
right?
sandwiches.
Correct. It applies to any business. Let's switch the business. Switch the industry. Let's go to fresh cut flour business. Where do you want your inventory turnover? How many days you want to have your inventory? In other
So
words,
long as the flowers d don't like, go bad. So like I don't know how long that would take for the flowers to go bad, but like usually it's a couple of days. So like you would have to have ho- a bit of, I'm guessing yeah, you have to have the right amount of inventory on stock.
and at the same time, you have to keep a very high inventory turnover.
Yeah.
Make sense? If you're asking for 2 days staying in inventory, your inventory turnover should be 183. That's gonna give you 2 days. So now let's go with account collections. That's another thing that I want you to understand. Accounts receivable turnover. Again, it's a no. Just give you a number. How many times? How many times what? You're collecting your credit sales. So where do you want this number to be high or to be low? And what means if this number is only one? Let's go with simple. If my accounts receivable turnover is one, what that means to us? You should use the same logic as the breadth and the inventory turnover.
It means that the net credit sales are equal to the net accounts receivable. So like they're not paying you back.
Or pay you only once a year.
Yeah,
Is that good for you?
no.
No. So where do you want the number? As high as possible. Make sense? 365, that's the best. If so, let's think about Xiaolin. If my turnover is 365, then what kind of business I'm running? Or how my clients paid me?
On a yearly basis?
Think about it. Let's go
As
with
you
the
start
cash.
during 1 year?
That is exactly correct, Xiaolin. I'm running cash business. If my watch this, Yuval. If my accounts receivable turnover is 365, that means I'm collecting. That brings us to the next formula. How fast we collecting our net receivables? Then we have a nominator is 365, and my denominator is 365. That means once I sell the item, the client pay me cash. Do you understand this?
The part
Yes.
I was about to say the part I'm lost is because like the denominator, when you put it to 365, that's actually one, but like if you lower it, it means like you're either running, depending, it means you're running a different type of business, whether it be a bread business and
No,
so
no, 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 no. In this case, we don't mix it with the inventory. We're
on.
staying on the accounts receivables, right? On
Oh,
accounts we are
okay,
on the accounts receivables here. So
okay.
basically, if the accounts receivable turnover is 365, that means you're running cash business
Yeah, I can see that because like they have to give it to you as
right away.
within a year. Yeah, right
Not
away.
not within a year, within the same day.
Yeah.
If your accounts receivable turnover is then is one, that means you collecting your credit sales only once a year. So your client don't pay you for entire year, or they pay you only once a year. Well, technically, you just literally sponsor their business. They're taking from you free credits. There's a question. Go for it.
If they're paying by cash, shouldn't it be like cash sales instead of credit sales?
It's going to be cash sales, yes. In that case, this ratio doesn't make sense, right? But
Yeah.
I want to purposely use that number so you can feel it,
Okay.
right? Here the formula, as you can see, the formula we're working with the net credit sales, but I'm using the turnover 365 so you can actually feel it. Now, is if it's 365, there will be no credit sale. No, will be no credit sales. There will be everything cash. But for the purpose of the exercises, so you can feel it, that's why I use that number. In reality, credit sales, if you collect the credit sales within 30 to 35 days, that's considered very. Now, this company, as let's go with this company compared to the industry, this company, uh, their first, the inventory turnover is 80 days. Industry average is 26 days. Where is the company compared to the industry? In the good position or bad position? Everyone in the
I would
industry in the bad position because everyone in the industry takes you 26 days to sell your inventory. For us, that takes 80 days. We're not in a good shape. How about accounts receivables collection on the net sale on the sales, which are credit sales? We collecting in 42.3 days, 42 days takes us to collect our credit sales. Everywhere in the industry, they're collecting in 16 days. Is that good for our company? No. Now the question is, what can we do? Can we speed up the collection? You have here suggestions how to speed up the collection. We can offer the client discount. We can change the credit policy. We can encourage the client to start using e-transfers. We can encourage the client to use the electronic fund transfers. Credit cards is also another way you to make the client to pay, because most of the client they want to charge whatever they're paying on their personal credit card so they can earn some miles or any points, whatever they're running. That would be another thing to do. So let's keep going with those ratios. We're going to the point of solvency ratio. Now, the solvency ratio is going to come from the proportion of your capital in terms of debt and equity ratio. Let's see the first one, debt ratio. Debt ratio, we're going to calculate it by the total liability divided by total assets. So what we're chasing, how much is our debt? Company debt. Nothing more, nothing less. If I calculate the debt ratio, if my debt ratio is, let's say here my debt ratio is 51, can you tell me 0.51 or 51%? Can you tell me how much is my equity ratio? Right away.
I was about to say 49%.
And you'll be absolutely correct. If you have said 49%, you'll be absolutely correct. Why? Because the total assets are 100. And if the debt ratio is 51, the equity ratio will be 49. There's no other options here. If so, what's happening with this company then? Are they increasing debt or reducing the debt?
I was about to say they're more like increasing the debt.
Why you not said?
Because like it's 0.55 compared to 0.51. That means like the equity is a lot lower.
What that means to the debt? Well, forget about the equity. We're talking about the debt ratio. Is it going up or going down?
It's going up.
It's going up. So what they're doing, they're increasing the debt.
Yeah.
If
Depends
they,
on situation. I remember you saying something similar to this a couple weeks back.
right. So now let's go here and do some thinking. Is that good for the company to get more debt?
Depends on the situation.
Depends on the situation. What situation? We need more information. So now, what kind of information we need? Let's go and quickly hear this. Here the leverage. Leverage is total liability divided by total equity. So basically, we're chasing how we're doing on that ratio. Total liability again divided by total equity here. Total asset divided by total liability. Why the debt ratio is not total asset divided by, because you're chasing which one is 100%? Farnosh, which one is 100%? Asset. Do you understand why? Now, do you understand why the total assets in our denominator? Okay, so let's go with the leverage. Leverage is what's the proportion debt to equity? We have here 1.24 versus first year was 1.04, next increase to 1.24. Industry is 155, 56. Where we are compared to the industry, in the better position on the leverage or worse position than on the average? Better. Definitely we're better. Now let's go to the next ratio, which is very important ratio. The next ratio is going to measure how many times you can pay your interest expenses with your income from operations. Again, it's going to tell you how many times you can pay your interest expenses, which is the cost of your debt, with your income from the operations. So what's happened in this company? In the first year, that number, so question first, let's bring this number to one. What that means, one?
It means that the income is equals to the interest expense.
It's equal to the interest expense. Is
Yeah.
that good for you?
No.
No. But it's not bad, right? But at least you're generating enough to pay your interest. You're not touching the principal that you borrow from the bank. So basically, the bank asks you to pay the money back. You have the cash. You have the asset. You can pay it back. But with the normal operation, you're generating only and only to pay your interest expense. Nothing more, nothing less. So being more than one, is that good for you? Yes. No questions about it. Getting higher, is that good for you? Yes. So let's think about this ratio for just for a second. This ratio in 2022 was 279, which we're saying it's a good thing because it's above 1. Next year went to 326. So that we have increase here of how much will be that 46 0.46 times. And as you can see, the cost of debt going up, but the income also goes up. Let's go back to the debt. What's happened with the debt? We increased the debt from 51% to 55%. Do you understand this? Now we're increasing the debt, but our time interest ratio also increase. How can I interpret this?
You can say that you increased like the amount of like debts or like from creditors, right? But you also increase like ways to gain money, like assets.
So what that means to me? Should I borrow more?
Yes. No?
That's what I'm asking. Should I borrow more then?
Yes. I mean, you have the money to pay it back.
So you have the money to pay back. In the money to pay back, it starts increasing. What that means for the debt, cost of debt. Keep going, think about it. Brainstorming here. We're doing the brainstorming. Keep thinking. You start thinking the right direction now. Keep thinking, please. Don't stop. I'm borrowing more, but my operating income starts going even higher. What that means to debt, to the cost of debt.
It's
Yes,
getting
you don't worry about the cost. You don't worry about the debt because adding more debt is going to help you to generate more operating income. What also means that you're above the industry average, going higher every year. Okay, what else? What means the debt? Where is the debt? What's the cost of debt? Is it high or low? Low. Do you understand this? If the cost of debt is low, that means whatever you're generating with your idea, it's profitable for you. Let's go to the Excel spreadsheet and let's think about it. I want you to feel this. This is important. Not, I mean, it's not important for this chapter. It's important for your personal life and you to understand those things. Because again, for me, it's more important you to feel the numbers and how the numbers going to hit you. Let's say, again, we have basic accounting equation. Let's get this basic accounting equation and let's put it here. I have my basic accounting equation. So now, the first year, I have liability and I have equity, which give me 100%, no questions about it. So my liability, let's say, is 50,000 And my equity is just I'm improvising with the number 45,000. My total equity and total liability and equity is 95. How much should be my total assets? If my total liability and equity is 95, how much are my total assets?
95.
95. Why took you so long? It should be just natural, 95. End of the story. So now, my liability here is 50,000 and my equity is 45,000. How those numbers are as a percentage now? That's what I'm trying to express. 45, 1, 2, 3. So what I'm going to do, I'm going to get 50 out of 95, 53%. And what's left for the equity? Not much. It has to be 47, correct? To bring it to 100. Now, my operating income for the period, let's say I have sales, I have expenses. No, let's put it here. Sorry, let's put it right here. Sales, expenses, and interest expense. Let's cut this one and let's move it right here. Now let me double check on the interest here. Do we have the interest income from the operation, interest expense ratio? Increase the investment company appears positioning, pay the liabilities. I wanted just to check something. Is this that no, interest expenses part of the calculation of the operating income or not? That's the only thing that I want to check. Just give me a second. Uh, so income before interest and taxes. So we have to eliminate that one. Okay, so we're gonna eliminate it in our formula. So let's say my sales are 100,000. My total expenses are 50,000. And my interest expense itself is 12,000. So what is my interest earn ratio? That's gonna be how many times from my operating income with my operating income can pay my expenses. My interest earn ratio will be, I have to get a number here, which we're gonna divide by the interest expense. Now my operating income, in this case, will be equal to 100 minus 50. Sorry, this one minus 50,000. So my interest on ratio is 4.75. So 4.75 times I can pay my interest expense with my operating income. In simple words, now let's bring it to 1. Let's bring it to 1. In order to bring it to 1, my expenses have to be 88,000. Correct? So what that means, my operating income I'm generating is enough only and only to pay my interest. Nothing more, nothing less. No, no, no. This is a random example. I'm using it for the random purposes. Has nothing to do with the slides. I want we to think about the ratios. So in this case, what that means, I'm borrowed $50,000. On how much is the cost for the 50, how much is the interest that I have to pay on the $50,000? It's $12,000, correct? Can I calculate my interest as a ratio, as a percentage? That will be $12,000 divided by 50,000. So I'm paying currently in the bank 24% interest. Are you guys with me?
Yeah, I'm with you, Ivan.
That seems a little bit high. Let's see here. So with my operating income, I can satisfy the interest that I'm paying to the bank. Correct? So now let's see if I increase my liability. I'm increasing my liability with another $10,000. Now I'm going with my liability. No, let's leave it this one here, 50,000. I'm going to leave it the way it is. Now the next scenario, what I'm going to do is I'm going to copy this and I'm going to flip it here. And let's increase our liability with 10,000. So the new liability will be 60,000. I want to keep the equity the same proportion. So the equity is not going to move. It's going to stay 45%, 45,000. Now the 45,000, that will be this plus this. So now this is going to be jumped to 60,000. And this one's going to jump to stay with 45. We're not changing that one. So what that means, I changed the proportion of my company. Now 57% on the interest. So my interest expense, as you can see, went down to 20%. But let's pretend I'm paying 24% interest. So that means my interest expense that I have to pay to the bank will be 60 times 24. I have to pay the bank $40,400. Now, if my sales now increase to $200,000 with additional $10,000 that I borrow, and my expenses increase to, let's say, 130,000, am I in good shape? Do I have to worry about the cost of the borrowing? No. Can you feel it? I increase my debt with $10,000, but that improved my operating income. That means whatever I'm running in my company, I have better idea. So I can pay now not only once my interest compared to this scenario, I can pay 4.86 times my interest expense. That means borrowing this shouldn't be stopping me. If that idea works and my sales and expenses moving to the same proportion, I should add naturally more debt until I see decrease in this number. Once you see decrease in this number, that means whatever you start running is not longer uh, justifiable, that doesn't justify adding more debt because the cost of the debt start dragging you down. Make sense? The other option that you have, watch this. Currently, you're in this situation. You're on the situation where the interest earn ratio is 1. Now, the Bank of Canada steps in the picture and in reducing the interest rate in the entire country. What's going to happen now with the interest rate that you have to pay to the bank? Most likely it's going to go down. If that's happened and the interest rate now go down to 10%, let's pretend to go down to 10%, how much will be your interest expense? $5,000. What's happened with the time interest on ratio? From 1 jump to 2.4. What that means? That means the debt now is cheaper. You haven't changed anything in the company. You're still doing the same sale, still doing the same expenses. If the debt getting cheaper, that gives you $7,000 income coming to your pocket now. Why? Because with the 12 you can cover the 5 and you can keep 7. Make sense? Now in this case, it doesn't make sense to borrow more. Absolutely. Because with the business model that you have, you're earning more interest, more income.
So a quick question about this.
Yes,
Is that the same thing as like, like I created my own book or whatever and I sell it on Amazon to like Canada and the US. So like, when I borrow more debt, I mean when I borrow more money from the bank to fund my business and its operation, so long as I'm making more than, what I borrowed, then that would be okay, right? Is it possible to do something like that?
absolutely. Absolutely. Watch this.
Because like, I've seen others doing it and making money.
So watch this. Let's go here. What's gonna happen? What's gonna happen if the total liability and equity is 95? Okay, now I'm gonna work with the other one. This one is 95, 1, 2, 3. Now this number here is gonna be 95 minus 45. And this one's gonna be, actually no, 95 is this one. This one will be that one. This will be 50. I'm trying to not to avoid the circulation of the formula. This one will be this one minus that one, but that's then now the circle of formula that's not gonna work. So let's say if my equity jump to 95,000, what's happened with my liability? If I increase only the equity, what's happened with my liability? Disappear, right? Do I have debt in my company? No, I don't have debt. Do I have to worry about the interest rate from the bank? Let's say right now the current interest rate is 2.5, I believe, so you can easily borrow something around 6%. In this case, you are interest expense free. Why? Because you're fully uh, financed by the equity and equity only. But when is gonna make sense you to start borrowing the money? If you have to grow, obviously, to grow, but how you should grow? So if the bank asks you for 6, so watch this. If bank asks you for 6% and you borrow $10,000, now you're changing the capital structure of your company. Equity in this case gonna go down to 85, correct? No, that will be opposite. Now, if you borrow 10,000, equity goes down to 85. Now I have 10,000. My interest expense now is 600. Correct? Are you guys with me?
Yeah, I'm with you, Ivan.
But now with the extra $10,000 that I borrow, remember in the previous situation, my operating income was 12. Now with the current borrowing, I was able to increase the sales for 120, and my operating expenses went up with, I'm trying to find the number here. Let me do calculation, a little calculation here. My expenses in 107, 400. Does it make sense for me to borrow money from the bank?
So long as your sales increase, then that's a good thing.
Watch this. If my equity is 90,000, if the equity is 95,000, if I fully finance by the equity, right? My scenario was here. What was that? My scenario. I'm making here 100,000. That was the number here, and my 100, 1, 2, 3, and my operating expenses were 88, 1, 2, 3. Why are these numbers bother me? Okay, let's make it this way. 1, 8, 1, 2, 3. So I'm generating 12,000. No questions about it,
Oh my, that's bad.
right? So if I increase my liability with 10,000, if I introduce 10,000 liability, doesn't make sense to add this debt to my capital structure now for the
No,
company.
it does not.
Why? Because the additional income that I'm generating just simply covers my expenses. Make sense?
See, that's interesting.
Can you see it?
Partially,
So your operating income increased with 600, but your operating expenses increased with 600. So basically, the increase in operating income, you're just paying your interest expense, and there's nothing for you. So that doesn't make sense. When this gonna make sense? Only and only if you're generating more. Now it makes sense. Why? Because you're generating 10,600 more with the 10,000 debt, adding to the capital structure of your company. So basically speaking is if your business generating operating income 10% and the cost of the borrowing is 10%, you're not making anything. But if your business model generating 10% and the cost of the borrowing is 4%, then it makes sense you to borrow money from the bank. Why? Because with the interest that you're generating, you have enough to cover your interest expense and you can enjoy your profit. That's the whole point of the borrowing. But again, play with the numbers. I really want you to start playing with the numbers and understand all those very complex financial, uh, what would be that, decisions by playing with the simple numbers so you can understand them and you can understand how it's possible to adding more debt for me to be good for my company. Well, it's because probably the debt is cheap and you have a better business model here. That's why you start generating even more income with the increase of your debt with $10,000. Sorry, interest expense with $10,000. So in that case, you can service your debt. and you're fine. Let's go for break now and finish with the last ratio, and I'm going to let you go. Okay, the next set of ratios is measure the profitability, pure profitability from different perspective, from the perspective of the return on sales, return on assets, return on equity, and earnings per share. So first one is the return on sales, measures how much net income we're generating from the sales. Again, that's percentage, basically what's left in the company after we pay all the expenses. As you can see, this company, under the current situation, they generating 5.6% return on sales, where the average is 0.9, so they're performing way above the average in this case. Return on assets give you ability to understand from the assets that you have how much net income plus the interest expense you're generating. So in this formula, you add actually the interest expense because you need that interest expense to cover the money that you're paying for the lenders. Since you have the two group of assets, one is coming from the lenders, the other one comes from the investors. That simply tells you with the assets that you have, do you generate, how much you generate, and where you are compared to the industry. We're generating 11.3%, where the industry is 7.8%. We are above the industry in this case. Next one is return on the common shareholders, return on the common shareholders' equity. So from the net income, after we pay the preferred dividend, how much left for the common shareholders? For the common shareholders, we have to use the average shareholders number, which will be the simple average, beginning of the year divided by plus the ending of the year divided by 2. And the last one that left is earnings per share. Now, for the earnings per share, you have this complex calculation, which we already saw in chapter 14, I believe, weighted average number of the common shares and how we calculate that numbers. There's a different way. I show you one of the ways. Use one way and stay with that way. So basically, based on when the shares are issued, what's the proportion of the month during the year which they're outstanding, and you're getting that number for the entire year. You're getting the net income minus what's this company don't have preferred shares, so there's nothing there. And you can see that the average industry, the earnings per share is 9.76. In our company, the highest one is the current year, 2023, 4.8. So how are we going to analyze that, the shares and the investment value? Investors, don't forget what different types of players want. Investors, they want dividend, which is direct return from the shares, that the amount of the money that they invest in shares, and indirect is gain when they sell the shares. And that's going to happen only and only if the selling price is more than the purchase price. So in order that to happen, the company has to perform very well over the period of time. The four measures of the shares are price earning ratio, dividend yield ratio, dividend payout, and book value per common shares. First one is price earnings ratio. That's a market price of the company, of the common shares to the company earnings per share. So once we have the price, which are currently traded on the stock market, and divided by the earnings per share, we're going to see that these numbers. If the earnings is negative, then the price earning shares in this case is not applicable. Now, if the market price was 50 at the 2023 and 35 2023, and we have the earnings per share, that means we're going to get earnings price earnings ratio 10.4 for the 2023 and 13.5 for 2022, where the industry average is 17.77. In this case, the company, we want to see increase that ratio, but that's preferable thing, which not always, as you can see, this case not always happens. Next ratio is the dividend yield ratio, which will be the annual dividend for common shares divided by the market price per the common shares. So what that tells you is, if the investor spend amount of money on the shares, how much he expect to earn. That's what it simply tells you. How much I expect to earn as a dividend, cash dividend, if I invest certain amount of money. The last ratio is the dividend payout ratio. Oh no, there's one more. Dividend paid out ratio. Dividend paid out ratio is from the net earnings, how much dividend we paying to the shareholders. This is a very interesting ratio because if you keep that ratio on the 100%, that means everything that the company earns paid as a dividend. Most likely, the market price of those shares will be very high. If the company decide to restrict the dividend and not to pay the dividend, this ratio can be even zero. That means the company doesn't pay dividend. Don't forget that paying the dividend is the discretion of the company. If they decide to pay dividend, they can pay dividend and may pay dividend. If they decide not to, they don't. The last one is the book value per common shares. The book value have no relationship to the market value of the common shares, and it's not going to impact any of the market value. Only it's going to show you if the shares of the company is currently undervalued or overvalued. That's the only thing that shows. You can use this ratio if you see undervalued company and buy those shares. Why? Because eventually the market is going to adjust or to the actual price of the shares. If you see that the book value per share is sitting higher than the current market value, buy those shares. Because most likely market is going to adjust and increase to follow the book value. Limitations. All those ratios are a good thing, but depends who interpret the ratio and how much knowledge you have on the ratios. And you cannot see the ratios as a single ratio and based on that ratio to base your decisions. You have to see it as a complex of ratios. The other thing that you have to understand is there's no anything is uncertain. Nothing is certain. There's so many unknowns. Everything can go wrong. With the ratio, you may find what is wrong, there's a signs that there's something wrong, but what exactly is wrong, it's not specifically answer to that question. When you're doing the analysis, you must evaluate in the light of the other information. Again, you cannot get the single ratio and based on that ratio to base your decision. You have to see different ratios, put it in the same line, and see if there's a trend, if there's anything pattern, and is there anything that you can draw from those conclusions from those ratios. Ratio should be analyzed over the period of years. It is the best to analyze the component of the ratio in order to identify the cause of the changes of the ratios. So the question is, if you see some changes in the ratio, can you find what the cause is? The other limitation is the current ratio is that what if the current ratio decrease significantly? What's going to happen then? Means that what if the current ratio drops below 1? Is that means cash shortage? Is that mean the company don't have ability to pay cash? It is because the inventory value went down, or is it because the cash accounts receivables are declining? What exactly that means? That's where the answers, that's where you should look at by knowing the elements of the single ratio and what's in the denominator and what's in the numerator. Non-financial data is equally important. From where you can get that non-financial data from any other documents which are related to the business and post it anywhere uh, in the internet environment what you can find. That will be the letter from the president to the shareholder, management report to the shareholders, management discussion and analysis. Most of the financial statement now have that element that becomes kind of mandatory for the company to report management discussion and analysis. Auditor reports, basic financial statements and notes. Don't forget to read the notes to financial statements. Any comparative information that you can find on the company. The other thing that you should look is company itself, mission, vision, good steward for the planet, supportive for the employee, changes in the sales and inventory, earnings per shares, all different indicators. What's the difference between the international financial reporting standard accounting standard for the private enterprises? Again, there's not much differences in here because basically everything is calculation. Now the only difference will be the numbers and from where those numbers came from and what's included, what kind of standards that apply in those numbers by getting the numbers where they are. And that can be crucial for interpreting the financial statements. And that's what it is, this chapter about.